What's going on, everyone, and welcome back to the channel. My name is Francisco, and today we will be discussing the differences between mutual funds, index funds, and ETFs. Now, I know you might have heard all these words used interchangeably, and they can be quite confusing, so this video will aim to break down what they are, how they differentiate, and which one you should be using for your stock investing strategy. First off, let's start off with the mutual fund. The mutual fund came before all other kinds of funds, so before the index and before the ETFs. So this was started off as a way for common people to get together, pool their money, and have one individual, which is the mutual fund manager. He would be the one responsible for picking out stocks. Now, this individual would be picked on based off of his curricular accomplishments through schools, things that he studied with, his knowledge on what good companies are and what bad companies are to avoid. What's good about being in a mutual fund is, well, first off, supposedly the guy that's in charge knows what he's doing, so he's picking good companies at reasonable prices, and he's not getting influenced by the markets themselves and not being part of the roller coaster. He's actually supposed to be level-headed, pick good companies at good prices, and just, let the investment ride out. The second thing is it's good for diversification if that's something that interests you. So let's say if you wanted to buy 100 stocks, you would have to pay commission on every single one of those stocks, which is, usually commission is $10, so 10 times 100, that's a lot of money just to try to even get into the companies of the stocks that you would like to own. So by buying into or being part of a mutual fund, that eliminates the commission fee, and you're already owning a bunch of companies. Another thing that's useful is you have the peace of mind of knowing that somebody is managing your stock portfolio and your wealth, and supposedly supposed to be generating more wealth for you than not. The fee structure for mutual funds is about 1 to 2%, so that actually really adds up over time, and instead of making, the industry average for the S&P 500 has been about 10, let's just say it's been about 10% since, way back when it started. It's been about 10%. But if you go into a mutual fund and he makes 10% and he's charging you 1 or 2 percentage points of difference, that's a lot of fees that is going to him just staying with the market. He's not beating it. And even if he beats the market, you pay fees. And even if he underperforms the market, you're still paying fees. So from a perspective of having to put in more work, why would you put in more work to, you're still going to get paid? So from that perspective, it's not really the best vehicle, because a lot of people, once they're in the job, great, I just get a free ride. I get a free paycheck no matter what I do. If I'm right, if I'm wrong, if I beat it, if I don't beat it, it doesn't matter. I still get paid. It's kind of like being a weatherman. If it rains, if you say it's sunny and it was gonna rain, it doesn't really matter. You still have a job, and that's not something that you want to be leaving up to chance when it comes to your personal finances, because that's the money that you're going to be using in the future to be able to retire on, or get your kid through school, or buy them a house, whatever it might be. And it's just not something that a lot of people liked. So that's when a guy named Jack Bogle created the first ever index fund. That's what we're going to be talking about now. He created the index fund because he's just fed up. He's fed up with the mutual fund managers and how they were running things, and most of them don't end up beating the market. 90-something% of them don't beat the market over long periods of time. After 5 years, most of them stop beating the market. So why are you paying fees into something that a guy isn't doing efficiently? So Jack Bogle made the fund, and those are probably the ones you're most familiar with, the S&P 500 index funds like VOO, things of that nature. And the fee structures are incredibly low. It's like 0.04% or something around that. It's incredibly low. Like on $10,000, if you're paying 0.04%, it's like $4 a year to be part of the fund, and all your gains are going towards compounding and making your money work for you and not working towards paying the fees of a mutual fund manager. And that's what even Warren Buffett says. When he dies, he's leaving his wife the money, and most of that money is going to go, like 90% of it is going to go to ETFs, and 10% of it is going to short-term bonds or treasuries or something along those lines. There's also an ETF. So ETFs are electronic trades funds. So many different kinds. There are kinds of countries. So you can have ones that follow the best companies in China, in Pakistan, Australia, etc., etc. There's some that follow currencies. There's some that follow specific sectors like tech sectors, cars, copper. That's more materials. But there's also materials. So if you wanted to get like gold, iron, silver, copper, aluminum, things like that, there's a bunch of ETFs. And how they differ from an index fund is that they're traded almost like a stock themselves. So you could go in onto Google Finance or Yahoo Finance or whatever it is and type in the specific ticker that you're looking for, and it's trading every day. So the advantage of having this ETF is that if you want to be able to pull your money out quickly, you don't have to wait until the end of the day like index funds. Index funds, you can only trade your money once a day, but an ETF, you can do it anytime you want, whenever. And that is an ETF. Now, the fees for an ETF are pretty much in line with the index fund. It's about maybe 0.1, 0.4, something like that. It's very minuscule for the advantages that you get of it. Now, I will say, there is another advantage or let's say disadvantage that an ETF has over an index fund. It is that you can see every minute of every hour that the stock market is open, you can see the price fluctuation of an ETF. And if you don't have the ability to just buy something, leave it there and let it, look at it 30 years later when you want to retire and use that money, and you're constantly looking at it, it went up, it went down, it went up and it went up, that's going to take you on an emotional roller coaster, and it's going to prevent you from being able to reach long-term goals, because you're going to want to just time the market, get into the market. Oh my God, the market is falling. I'm going to pull out, sell all my shares, and then I buy in and then I buy out. And it's just statistically proven that you get better results just by staying in the market all the time, through ups and through downs. So I would say that is a disadvantage of an ETF. When index fund, you could just keep your money in there, and monthly payments can automatically come out of your bank account. So most index funds, you could link it up to your bank account, and then every month, or even on bi-weekly, when your pay comes out, you could take $400 bi-weekly and then buy the index over and over and over. And after 30 years, if you believe in the American economy and the United States, it's just going to go up. Like it's been going since the 1700s, whenever the first stock market opened up here in the States. I think it was in the 1700s. I'm not too sure about that, but it has been, the United States economy has been going up and up and up. And if you buy an ETF, specifically the S&P 500, so the VIX or VOO, it is basically betting on America. That the American economy will keep going up and up and up and up, and the companies will keep getting better and better and generating more cash and more money for its shareholders. In this case, that would be you. And that about wraps it up for today. Thank you, and until next time,